After many years of low interest rates, the Fed has recently increased interest rates rapidly to fight inflation, and this has pushed mortgage rates to crazy high level not seen in our generation. And this has caused many people to be concerned with their mortgage payment. Some have reached out to me to ask if I should be concerned as I have multiple mortgages on my properties. And my answer to them is no. Why? Let me explain. Because of the rising Fed fund rate, US 30 years mortgage has risen to highs not seen since 2001. That's almost 20 years. In the past 10 years, most people in the US are used to seeing mortgage rate of about 3% on average. It has now doubled to over 6%. Similarly, Singapore mortgage has risen to above 4%, where 1 to 2% used to be the norm. This means that mortgage payment would have likely risen by almost 40 to 50%. Let's take a look at a few examples. In the US, for a 30-year mortgage with 3% interest rates, the monthly payment is about $1,000. At 6% interest rate, which is lower than what we are seeing today, the monthly payment has risen to $1,400 or 1.4K a month. That is an almost 40% increase in payments. Similarly, in Singapore, a 30-year loan with 1.5% interest for an average $1.5 million condo cost about $5,000 per month. At today's interest rate of about 4.25%, the monthly payment has risen close to 7.3K. Again, that's about 40% increase in payments. Furthermore, the Fed has signaled that they will continue to keep interest rate high into the 2024 and 2025 as they try to slow down inflation in these 1 to 2 years and then bring it down to 2% to where we are used to.
In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value.
And this would mean that mortgage rates will continue to stay elevated, which also means that the financial strain of high mortgage payment will continue to impact investors and homeowners. Why is it a concern to some? Two main reasons: over-leverage and negative cash flow. While most of the investors and homeowners are prudent, some may have pursued deals aggressively and have over-leveraged. Their debt-to-income ratio is high. So when interest rates and mortgage payment increases, they are faced with financial hardship. Similarly, some investors invest for appreciation and they accept negative cash flow deals. So this means that their rent is lower than their mortgage payment and other operating expenses. So when interest rates and mortgage increase, it will add additional strain onto their budget. Some may be forced to sell, while a small group may have to be foreclosed on. This is why some are concerned with rising interest rates. So why do I say it is not a concern to me? Firstly, it's because my interests are fixed for 30 years. Yes, in the US, there's such a thing called 30 years fixed rate mortgages, which means that the interest rates are fixed for 30 years. Unlike some countries where they are fixed only for the first 2 to 3 or even 5 years, and then it will float. And this means that you will be subjected to the rising interest rates and you'll definitely be hit by increasing mortgages. Secondly, positive cash flow. The investment properties that we invest in are cash flowing. This means that rents are above mortgage payment and other operating expenses. So should mortgage payment increases, we will still have the buffer to absorb. And they are indeed concerned of falling home prices. Although not impossible, should a case whereby a 20 to 30% fall in home prices, some of the banks will do a margin call, where banks will require a top-up to meet the loan to value. But this is not the case for the US mortgages. They are non-recallable, no margin calls for them. So I do not need to worry about falling home prices. Of course, this is not a likely case, and if it really happens, banks will do their best to work with the borrower for them to keep their houses. But if we can avoid this right from the onstart, I should. So having no margin call is a good thing. But I do see some benefits from the rising rate hikes. Firstly, it should cool down the market as buyers have less purchasing power. Yes, although it may affect my property values, which means it will drop, but it doesn't affect me at the current moment because I'm not aiming to make money from the appreciation. I will share about how I monetize appreciation later. At the current moment, I'm making money from the cash flow. So having a lower property price means that I can buy property at a cheaper price. Previously, when interest rates was low, demand was high, there was totally no negotiation power. Everyone could afford and everyone was overbidding and competing.
Falling to the ground, shoppers charged ahead, fixated on doorbuster deals. 13-year-old girl helping a pregnant woman get up had to be taken away by ambulance.
So now with higher interest rates, it gives me the opportunity to find better deals and I'm looking forward to it. At the same time, 30-year fixed rate doesn't mean that my interest rate don't change. If and when interest rates reduces, I can refinance to a lower interest rates and my mortgage payment will be reduced. There's a saying that goes, I can always change my interest rates, but I can never change my purchase price. I'd rather buy low at a higher interest rates and then refinance later than buy high on low interest rates. When I buy low in a high interest rate environment, when interest rate goes down, it will usually push up asset prices. And this creates instant equity for me. It's like money being created out of thin air. And that's what I like about real estate. And the best thing is, I don't have to sell to make my money. I can do a cash out refinance and make my money work harder by reinvesting in another property. This means that I still keep my initial property with these two properties to enjoy future rent growth and home price appreciation. You make money at your buy, not when you sell. Oh, I mean cash out refinance. We don't have to sell. So as you can see, there's really no concern of rising interest rates on the properties that I hold. This is unique in the US because of the 30 years fixed rate mortgage with no margin calls. And it also offers me a chance to buy low today while being able to refinance in the future, yet at the same time keep the initial properties while increasing the number of cash flowing properties to allow future rent growth and home price appreciation. If you think that this video is useful, please like and subscribe so YouTube knows that it is a good video and spread it to more people. If you're curious on what a cash out refinance is, how you can invest in a property, pull out your initial capital, invest in the second one while keeping the first one, check out this video here. And if you want to find out 4 ways rental property can make you money, check out this video here. I thank you for your time. I wish you a very good day. I'll see you in the next one. Cheers.